Right. Yes, we can start the discussion. A very happy New Year to you all. Hope this year will bring much more happiness, prosperity, and hope your expectation in terms of examinations and things also come true. That's been said. I think we have started discussing one of the very important topic, understanding interest rates. I'll get into that in details. Before that, as usual, please feel free to communicate if you have any observation or you wanted to see any further clarity in terms of what we discussed up to now. You can drop a message through chat mode, or you can, in fact, unmute and present if you have a consideration. So that's been said, we'll move on with our discussion. I briefly touched upon the importance of interest rates in our last discussion. Okay. And also to the extent that we will be discussing the so-called real interest rates. That is very important concept in interest rate analysis itself, simply because you probably see interest rates at different time periods of your experience. For instance, last year's interest rates compared to this year, probably different. Even for that matter, even last month's interest rates compared to current interest rates, maybe not that different, but maybe different. And if you look at the circumstances in which interest rates been looked across different countries, again, it's different. But then the concept of real interest rates make certain kind of effort to bring interest rates across different times to equal footing by taking out the inflationary impact within the interest rates. You take out inflation from the interest rates and then see what is the real return for whatever investments that you make. Effectively, that means the inflation would reflect the prices, adjustments in prices, increase in prices. So if the prices have gone up from 100 to 104 by this year, so basically if you have invested in an investment of 6% return, what your return for 100 investment is 106. Interest rate is 6. So interest income is 6 plus your principal, it's 106. But effectively, you know, inflation was 4. Right? So when the inflation was 4, 100 rupee, whatever, now it's cost you 104. So inflation is 4 if you take out the price difference. So what you are basically seeing is from the return of 6%, you take out the inflation of 4, you ended up with 2. So that's the real interest rate. So we compare these real interest rates in terms of so-called Fisher equation and try to understand the very important considerations across different time periods when it comes to interest rates analysis. So that is very important lesson that you will learn through all these discussions that we are trying to see in terms of financial assets as well as in financial markets and in monetary policy. Okay. And then, of course, we also look at so-called yield to maturity. Okay. And that is in a way a concept, and that is known as the most accurate measure of interest rates in terms of financial assets being concerned. The yield to maturity is what economists mean when they use the term interest rates, because what you basically see is when you look at a financial asset, and you look at it from the perspective of what would it return in a current sense, and also from a sense if you hold that asset until it gets matured. If it is a 5-year bond, either you could have it today and for 1 year and sold it off in the market, or you can hold it till maturity and see what is the yield to maturity is, YTM, yield to maturity. So more appropriate measure of ascertaining return of a financial assets is yield to maturity. You keep that. Of course, in the middle, you may be sell, and then of course it may differ to yield to maturity based on the interest rate prevailing at that particular moment of time. But if you hold the asset until its full lifetime, whether the interest rates move up or down during the lifetime of that financial assets, that's not going to change your yield to maturity, because from the time you invested, your investment outflow is very clear. At the time of maturity, you know what's your return in terms of principal, and then periodic coupons for bonds, example I'm taking. So you see, if you take it in that perspective and calculate, what you are getting is yield to maturity, right? So holding period is the duration of the asset. You don't do transactions prior to maturity, so you can derive the yield to maturity. But if you do the transactions prior to maturity, what happened here is you expose yourself to the interest rates volatility in the market. When you expose yourself to the interest rates volatility in the market, your yield may differ to yield to maturity, because during the lifetime, interest rates would not be the same. It changes. But you take out that from your computation exercise by holding till maturity. So you know the cash outflow, you know the cash inflow at the maturity and in the interim period. So you can precisely calculate at the investment itself what would be your yield to maturity by keeping that until maturity. But if you do the transaction before the maturity, then it changes, because the price that you might get different to what's the face value you get at maturity, and also in comparison to what you have invested as the investment price at the initial stage. So that would decide whether you have a capital gain, capital loss, all kind of discussions that you will come across in this section. So that's a very interesting area, yield to maturity. And then, of course, real interest rates, as I was already mentioned. Okay. So then you see the investment in comparison to one financial asset to other. Bond versus stocks. Bond versus savings, right? Saving versus real estate or whatever. Various assets that you come across in financial market. Okay, so that also we would see in our exercise. Okay, we will see this in our discussion as we try to elaborate things, and then we move into a kind of a basic concepts. These are, to some extent, I believe some of you are already aware in terms of your understanding with respect to the concepts that we are familiar with, but we will see what these basic concepts in terms of interest rates that we are discussing. The present value. Okay, that's a very important concept when it comes to interest rates discussions. When you say present value, today's value of future cash receipts that you will get. For instance, $1 paid to you 1 year from now, you will be getting $1 on 2nd of January 2022. Okay, so you have to see whether that dollar that you are receiving 1 year from now in terms of today's value, because why it's important here is $1 paid to you 1 year from now is less valuable than $1 paid to you today, right? Assuming there's inflation. right? So you have to make sure there's inflation. If it is deflation, the concept is different, right? So if you know tomorrow's prices are cheaper than today's, you will not do transactions today. You will wait till tomorrow, unless it's a basic needs like food, right? So you see, then the tomorrow's price is cheap, so you can buy more by paying the same value that you require to pay if you buy today. So then what happens is all economic activities get postponed, and economies become vulnerable to a lot of other shocks. We will take those stuff when we have opportunities to discuss. But what is important in terms of present value discussion is you always wanted to know a future cash inflows value in today's context, simply because today's dollar is valuable than tomorrow's dollar. Okay, so what you do here is, when you do a today's receipt instead of receiving 1 year from now, what you simply see is this dollar that you are receiving can be deposited and earn an interest income. Or you can invest. You don't need to deposit, but you can deposit or invest and then earn an income, either interest or other forms of income. So what it becomes is $1 times 1 plus I. 1 plus I is, right, interest rate. I is interest rates here. So when it comes to interest rate, it could be 5%. Then it's like 5%, 1 plus 5%. So it is 1.05. So at the end of 1 year from now, you will get $1 into 1.05. So that's the way in which that you compute these things. It's a very simple, straightforward calculation of interest return and the principal. So today's dollar is valuable with interest earned more than $1 if the interest rates are positive. If I is negative, it's a different call, because there are circumstances in the world where the interest rates also become negative, right? I simply say that that's very exceptional, but that's also possible. Okay, but in such circumstances, you probably see that you invest today, and at the end of the year, you are getting less than what you invested today. You invest $1 today, you get at the end of 1 year less than $1, right? So you then compare that with today's possible purchasing parity. So then you see still that less than $1 may be worth, rather than just keeping a dollar with you without investing, because then you have to incur a lot of other security, various type of considerations, right? And inflation would be, in such circumstances, may also be negative. That's why interest rates is not negative. Then concept of real interest rates that we are discussing would be very important and very valuable to see from a real sense how much you have earned even in a negative interest rate environment. We will get into those stuff little by little as we move on, right? So when it comes to the interest rates, we look at the present value now. We similarly discount our assets into the future. Okay, so as I simply said, interest rate I said 5%, but you just take it as 10% as per the example here. So what happened here is, in 1 year time, if you invest $100 as per the example at 10%, interest rate is I is 10 here, right? So you are getting 100 times 1 plus 0.1, that is 10%. If you put that in a percentage form, it's 10%, but when you put it in absolute form, it is 0.1. So you just take the return and you ended up with getting $110 in 1 year of investing 100 rupees at 10%. And if you look at this for 2 years, okay, in 2 years, you know now at the end of first year you get 110. And then in the second year also interest rate is 10% in this example. So 110 into 1 plus 0.1. So you get 110 into 1.1, okay. So you ended up getting 121, okay. So if you only look at interest return in the first instance, first year, it would be 10. In the second instance, it is 11. That is simply because interest on interest compounded here in the second year. Or you can put it in a straightforward way rather than calculating individual years, and you will easily write the equation as $100 into 1.1, 1 plus 0.1, that is the interest rate, to power 2, because it's 2 year. If it is 3 year, you can make it 3. Okay, so that's what the example is. So you can go on individually, you can calculate this return for $100 in terms of 10% interest rates. In the individual years, 110, then again 10% return, then you see 121, then 121 into a 10% return, then you get 133. So you can go on like this. But from a straightforward equation per se, you can again compute by bringing in number of years in a power sense, power term, and you can make this equation for number of years simply given as n. So what you are getting here is, if you wanted to see $100, how much it returned in 5, 10, whatever number of years, when n is defined for years and I is defined for interest rates, times $100 time 1 plus I, all things to power n. So you will get the answer by simplifying these things. These are very straightforward things, so I'm not individually kind of try to solve these type of simple computations. It's very straightforward, and you can basically get, okay, the return from these assets across a longer duration. Okay, but the concept of present value, okay, how you derive in terms of a present value is, you know in future your cash flow receipts, and you know what's the interest rates that you probably be getting if you invest that for the duration, as we were discussing in our first example, 1 year, right? In 1 year you get $1, right? So wanted to see what's the present value of that. So if you get that $1 today, you invest that for a 1 year from now, you know the interest rates. So you take the interest rates also into the equation, and you know cash flow, how much you get at the end of 1 year. So the present value is cash flow over 1 plus I, that is interest rates, to power n. 1 plus I, the power n, because number of years, if it is 1, it's 1. If it is 2, it's 2. So what you are basically seeing is, if you are going to get $1 in the future at 5% interest rates, 1 over 1.05, the answer would be less than 5, because denominator is greater than 1. When the denominator is greater than 1, the numerator is 1, the outcome that you are getting should be less than what is in the numerator. So present value of future cash received adjusted for interest rates, what you are simply getting is less than the what cash flows that you are intended to receive. So then you compare that, whether that $1 is worth today or tomorrow, based on the price structures in a country. So if you see present value is worth of receiving that today itself, rather than wait until 1 year to receive it, you will accept the present value and you see, okay, I prefer not to receive it in 1 year. I will go for a direct receipt now. So it's a conceptually that you are comparing. But even if there is a non-availability in today's sense that you will be receiving this $1, what you are basically seeing is your future receipts, how much it's worth in today's money. What you are basically doing is adjusting that future receipts to interest rate that you will be receiving if you invest that today, and seeing whether that is worthwhile. So basically, you make it like future receipts to today's perspective and see what the present value is. So if the present value is attractive, that you basically see the future receipts are welcome. If the present values are not attractive in terms of the interest rates that you are looking at, you prefer not future, but today itself. So it's a comparative analysis that you will look at in terms of present value in discussions. Another very important aspect is the timelines, right? If you look at the interest rate differs across number of periods, okay? Because what you are simply seeing is the timeline would give you a different returns based on the interest rates prevailing at that time. But as I already said, if you wanted to see yield to maturity, you can still compare by ignoring the timeline, because you know the receipts and you will not be doing any transactions during the lifetime of that asset. So when you see an asset where from a timeline perspective, you have different years, you can assume a number of years like 5, or for that matter now N here. It's not because of anything, but to make sure it's simplifying. You don't need to worry about whether it's a 3-year or 5-year, 8-year. No, number of years, you can simply say N. So you have $100 at first year, $100 in the second year, $100 in nth year, fine. So the present value compilation is you have $100 that you are receiving, 1 over I. Okay, if the interest rate is same across the period, right? 1 plus I to power 2, because you know 1 period interest rates. So if not, if it is nth year, you just make it 1 over 1 plus I to power n. So that would give you basically what you receive in nth year from now, how much it's worth in today's value, if it is 5 years. So you can, across the different time horizons into the future, you can make an understanding of what's it's worth in today's value, and through which what you would be looking at is that whether that is investable, worth for consider, or take it up in today's context and invest, all kind of different decisions. But what made you to analyze and review and come to that conclusion is nothing but the interest rate. So interest rates give you that input for you to kind of make across different timelines to the future in terms of your assets and expected receipts, expected cash flows. That's what the equation was. Okay, your cash flows. You know, you are renting out a house for 2 years from now, for 2 years today. So first year, what is the return you are going to get in absolute value? You know, you fix the value. Second year, how much you are getting, right? So you then see, okay, I'm getting 50,000 first year, and effectively a monthly 50,000 means it's 600,000, and then second year 50,000, you don't have a change in the contract, so against 60,000, 600,000, then you see interest rates today at 5%. What's the present value is? 600,000 divided by 1.05 for first year. And when you go to the second year, 600,000 divided by 1.05 to power 2. and you see what's the absolute return. So if you simply see that absolute return is not worthwhile in terms of today's prevailing interest rates, you would ask them in the contract, no, 50,000 for first year, second year, I have to increase the rent or the lease for a higher value. So all that decision is possible because of these interest rates that you have looked at. Okay, so these are kind of, introduction into the interest rates that you will be looking at. But different market instruments that you will come across in financial markets have different type of interest rate application. These are very basic, just you can take it to your head, and I'm pretty sure most of you all understand these things in terms of your day-to-day engagement with financial market assets. But what I'm simply saying is, some of these concepts would be very interesting to know. You would not formally understood these things. Now you are trying to learn it formally and what it is, and try to learn it from a perspective of how these concepts being looked at and applied in financial markets and also in economics, right? Any questions? Okay, so let's move on. So we have very easily recognizable 4 types of credit market instruments. You see simple loan, fixed payment loan, you would see coupon bond, and then you see discount bond. Okay, so discount bond, in another way, you can call it bills, right? But still you can call it discount bond because those are priced in a way that is discounted basically. So we'll come to that in details, but these are kind of 4 types of credit market instruments that you generally familiar with and you will come across in any financial market. Okay, and before we try to get into these simple loans and other financial assets, I will make this yield to maturity a formal kind of explanation when it comes to the concept of yield to maturity, YTM. I touched upon it at the very beginning of today's discussion, but you have to understand the fact that YTM is the total return, total investment return anticipated on a financial asset, in this case a bond. If the bond is held until end of its lifetime, I was mentioning held to maturity. If you hold the assets until it's mature, what the return that you are getting is known as total return, and it is nothing but yield to maturity. Okay, so when you keep this to maturity, it's a kind of a long-term return. So it's a long-term bond yield in this case. Okay, but we express it as an annual interest rate, but we call it yield to maturity simply because you do not take the volatilities in the market into the equation, but you hold this financial asset from the date you purchase until its lifetime expires. If it is a 5-year, until the end of 5th year, until the end of 10th year if it is a 10-year bond. Okay, so during the lifetime you will get the coupon, at the maturity you will get the principal. But at the initial point, whether you invested at the face value itself or at different value, would decide what's the effective yield to maturity that you are getting. Okay, so this would give you an insight into, without looking anything else, you can come across, okay, whether you are buying a bond or a financial assets at a price below its face value or at a price above its face value. We will come with greater details, but to illustrate, let's assume that a 5% $100,000 bond will mature in 5 years and will pay interest in June and December. 1st of June and December 1st. That means interest rates are paid on a 6 monthly intervals. So if 5% interest, 5% interest of 100,000 bond means if it's paying this 5% in 2 installments in a year, in 1 installment, how much you are getting? It is 2.5%. Right? 5% is per annum. Always you express interest rates per annum. Unless somebody very specifically say per day it's 5%. Like people who lend money in the PETA market. So you give 1,000 rupees to one person and tell them in the evening you have to give 1,200 rupees to me. So 200 rupees return per day. So you calculate that 200 rupees over 1,000. You will get an astronomical number if you compare it to per annum per se. Okay, 20 over 100. So you see what's the return that they are getting. So you can figure it out. That's per day, right? So per year you can multiply that by 365. That's what, unless otherwise they specifically say something. Generally, if you say 5%, it's a per annum interest rate. So if the bond is paying interest in semi-annual intervals, so it's the half that you get at one interval and the balance half in the second interval. Okay. If you look at 100,000 into 5%, it is $5,000. So bond will pay interest of 2,500 every 6 months until it matures. So if you draw a timeline, first year at 0.0, you are investing 100,000, assume. At the end of 5th year, you will be getting face value 100,000. That's fine. And the interim 0 to 1, 0.5, you have $2,500 because 5%. And then 1, you get another 2,500. 1.5, you get another 2,500. 2, you get another 2,500. 4.5, likewise 4.5 years, you will get another 2,500. And at the last 5th year, you get 2,500 balance coupon of that particular years plus 100,000 you already mentioned, face value. Okay, that's the timeline if you draw it. But every 6 months, 5% would return 2.5% for your investments. Okay. So if the current market interest rate, so that's the bond 5%, but now you are looking in the middle of the equation, current market interest rate for this bond, this type of bond is 6%. Okay. Very simple, 6%. Bond is giving you 5%, but current market interest rate is 6%. So you are actually having a return 1% less than what's the current market interest rate with respect to this type of bonds. So you actually you should receive 6%, but you are receiving only 5% because this bond is paying 5. So what you basically do in such circumstances when you are buying a financial assets, you adjust your purchase price for that additional 1% interest rates that you require. Okay, so that means you have to pay less than the face value 100,000 referred here to accumulate that 1% that you will be not getting if you invest in this bond at 5% based on current market interest rates of 6%. Because interest rate is 6, but bond coupon is 5. Okay, bond interest rate is 5. So what you are basically seeing here is the current market interest rate is greater than the bond's 5% coupon. Okay. So what you basically seeing is when the current market interest rate is greater than the 5% interest, you will be buying the bond at a price less than what you are simply seeing in its face. That means the face value, 100,000. Okay. So the market value of 5% bond in a 6% bond market will be approximately $95,735. You can calculate it because it's a 5-year equation. I'm not worried about the compilation of that, but very simple thing I just wanted to emphasize here is when the bond says it's paying you 5%, and when you see the market interest rates are higher than, greater than that 5%, you have to get some form of compensation from this investment in the form of not paying its face value at the time of investment. So you pay less than the face value because your interest rate experience in the market is greater or higher than what this bond is paying for you. So you are paying always lower than the face value. Okay, this is the present value of the 2,500 interest that will be received every 6 months for 5 years, plus the present value of $100,000 that will be received at the end of 5th year. So if you do the compilation of this, right, at 6%, right, this is the present value you will end up. So that would say all the cash amounts are discounted by the market interest rate, right? However, the 6% annual market rate will be restated to be 3% per semi-annual in the exercise, because 5% is restated as 2.5% for 6-month period. So if you are taking 6%, you have to make it a 3% semi-annual period, and 5 years will be restated to be 10 semi-annual periods. I mean, this is the timeline we are trying to explain, but very simple principle that I'm trying to explain to you is when you see a bond which is paying a coupon and that coupon is less than the market interest rate, or from another side, another way of explaining, the market interest rate is greater than the coupon interest rates, you will be buying this bond at a price less than its face value. So we call, in a simple sense, we buy this bond at a discounted price. Okay, here the example is 100,000. If it is just 100, you are buying it at a price less than 100. The market interest rate is greater than the coupon interest rate, or in other words, if the coupon interest rate is less than the market interest rate, you are buying a bond at a discount. The same thing now we will look at it from the other perspective. The market interest rate is 4%. Coupon is 5%. Market interest rate is 4%. What it means is market interest rate is lower than the coupon interest rate. Then you will be buying this bond at a price which is higher than its face value. It's a very, very simple but very, very important and fundamental aspect that you have to understand. When 6 is greater than 5, what is 6? Market interest rate. What is 5? Coupon. What you are buying bond at a price which is lower than its face value. Okay. The face value is 100. You are buying at a price below 100. If the market interest rate is 4% and the coupon is 5%, you are buying a bond at a price which is greater than its face value. If the face value is 100, you are buying at a price more than 100. Okay, so by looking at this, another point will immediately come to your mind is, if the market interest rate is equal to coupon interest rate, market interest rate is 5, coupon interest rate is 5, then you are buying a bond at its face value. The face value is 100, you are buying the bond at 100. Please don't forget this. This is the basic. You have to remember this. You have to understand this. Where if the market interest rates are greater than the coupon of a bond, you will be buying the bond at a price lower than its face value. We call such purchasers as discounted purchasers, discounted price. If the market interest rates are lower than the coupon interest rate, you buy the bond at a price higher than its face value. We call such prices as premium prices. Premium, discount, premium. And when the market interest rates are equal to the coupon interest rate, we buy the bond at its face value. If the face value is 100, we buy at 100. And we call such prices as par value bonds. Discounted bonds, premium bonds, par value bonds. Concepts are very straightforward, very clear, right? But what is interesting is, if you wanted to have a return which is not changed from your purchase to maturity, you have to hold the bond without doing anything in the interim. So holding period is the lifetime of the bond. So then yield to maturity would not change. So still that could be, yield to maturity could be higher than the coupon interest rate, or lower than the coupon interest rate, or equal to the coupon interest rate, based on at what price you are buying this in the first instance. If it is a discount price, yield to maturity would be greater than the coupon. If it is a premium price, the yield to maturity would be less than the coupon. If it is same, right, the yield to maturity and the coupon would be same, 5% in this instance. So this looks like confusing without getting into the technicalities, but very straightforward from this explanation. Try to get that. You will be able to understand it once you start reading. Any questions over here? Right. So we'll move on. Okay. So we see the concept of yield to maturity, and you have understood the concepts where the coupon rate and the market interest rates that would drive whether you are having a discounted price bond, premium price bond, or par value bond in the outset. So it's a comparison between straightforwardly the market interest rates and the coupon rate, and you define, without any calculation, you can define the price would be either greater than, lower than, or equal to the face value. You can define it by simply looking at coupon and the market interest rates. You don't need anything else. Then the final output or the calculation would give you the precise number. I don't worry about the precise number. I wanted to see the direction, whether you are getting a price less than 100, greater than 100, or equal to 100. So if you have that understanding, whatever computation you do, you are sure this price should be right less than 100, higher than 100. So the compilation, even if you do a mistake, you know conceptually, oh, I have done a mistake somewhere. That's why the price is now different. So you compute that. Okay. So you see now the different financial instruments that you come across. Okay. So when it comes to simple loans, the basic feature there is the simple interest rate applies to that simple loan equals the yield to maturity. That means this loan is basically held until its lifetime's over. Okay. So for instance, present value, amount borrowed equals, let's say, $100. Cash flow in 1 year is 110. That is n number of years. Now in this case, 1, because it's 1 year. N is 1 year now. So $100 you get today, that's the present value. The cash flow you get 110. Okay, that's the value that you get in 1 year, over 1 plus I. 1 is the variable given, and the interest rate we don't know here. To power n, n is 1. So very simple. You see the simplification of this equation. You take the denominator to the other side of the equation. That's where the $100 is. Then 1 plus I times $100 equals $110. So you now leave 1 plus I in that section and take the 100 to the other side. That means it's become the new denominator of 110. So you simplify 110 over 100, that is 0.11. You know interest rate in this instance based on 1 plus I, and the answer is 1.1 here. You take 1 to the other side, you will end up with 0.1. It's very simple mathematic computation. I'm not trying to read, or nobody would wanted to ask you this type of thing, but conceptually what you wanted to know here is interest rate you can compile basically based on your receipt, the cash flow, and the present value, right? If you don't have the present value or the future cash flow and you know the interest rate, you can compute it if you want. The same equation, present value equals cash flow over 1 plus I to power n. You plug all the information available and you derived here unknown factor interest rate, that is 10%. So in the simple loans case, what you are basically seeing is interest rate is no different to yield to maturity, because you keep the loan until its lifetime's over. So this is one financial assets that you will come across. You go to a bank, they might basically structure a product like this and give it to you. And similarly, if you go to a financial market, they might give you a fixed payment loan. Okay. So what basically you see here is you have a fixed value to be settled every year. Okay. So when it comes to fixed payment loan, a fixed rate payment is the amount due every period. If it is a year, every year, by a borrower to a lender under a fixed rate arrangement. The fixed rate loan payment will be equal amounts until the loan plus interest are paid in full. So basically what they are trying to see is they structure the product by looking at the amount they wanted to loan to you and the interest rate, and they know, okay, you are getting 100 and you will be having a 10% interest rate, so requirement is 110. How this 110 being settled, right? They wanted 5 periods, and the one period should be in terms of 110 divided by 5. So you see it's 22 in that instance. 110 divided by 5 is 22. So each period you have to pay a fixed amount to the lender. So here, basically, because of the patternistic nature of payment, initial payment would have more interest component because the loan value is still bigger, and next loan value is slightly lower now because you have paid part of the loan value, not the interest, in the first payment itself. So you get a portion of that loan value now deducted in the equation simply because you have already paid, but interest rate you have to pay for the balance portion. Then you have a more capital component in the second payment. Likewise, it goes to the last payment where you will have more capital component. Initially, it's more of interest components in your fixed payment, and gradually that reduces, and finally more of capital component in your fixed payment. Okay, so what's a fixed payment loan is you pay same cash flow payments every period throughout the lifetime of the loan. So loan value, you say LV, that's the equation. Fixed yearly payment, let's say FP, okay, FP, n number of years until maturity. The first year you are paying, if you wanted to see the loan value being calculated, 1 plus I based on the interest rate. Second period, the payments are same, FPs are same here. Loan value also mostly known. So we have to compile in such circumstances what is the I is. So basically I would give the same formula that we used in previous exercise, and we will end up with the I if you see all this information. Or if not I being given, you can compute the fixed payment or whatever if the loan value and the I is given here and the number of years is given here. So it's a kind of a patternistic nature in which that you are looking at your payments, but don't worry about the compilation side because the concept is the importance here. So you are paying equal installments across the lifetime of the loan when it comes to fixed payment loans. That is what important in this concept. And what is important in another sense is in immediate fixed payment components, loan components, interest payments is higher. As you go towards the last few of fixed payment components, the interest component reduces, the capital component increases. Okay, so it's the interest in bigger share in the first few fixed payments that you are looking at, and it gradually reduces, and then capital component increases. And but towards the last payment, the capital component is very much. So you see the patternistic way in which it's operates, right? Then the coupon bond. Now you know bonds are coupon bearing. Bonds are coupon bearing. Any financial assets that you look at it, it carries a different type of returns. But when it comes to a bond, often conceptually the bonds carries coupons, right? So this coupon are mostly paid on semi-annual basis. That means 6 monthly basis, but there may be coupons being paid at different time intervals, 3 monthly basis, monthly basis, it differs, right? But general, most of the bonds that you see in the markets are semi-annual basis. A coupon bond is a debt obligation of the borrower, okay, with coupons attached. But in realistic sense, you don't see coupons attached, because in the past, when you see a bond certificate, the original investment is the main certificate, and then you see coupons. You can flip it over, you can remove it when you pay, right? So for instance, if it is a 5-year bond with semi-annual payment, with the bond certificate, you have a coupon attachment where you have 10 pieces of coupons. 5 years, semi-annual, right? 2 times per year, 5 into 2, 10. So each payment time, you remove that portion of the coupon. And you had to go and give that to the borrower or the issuer. He will pay the coupon. But this is cumbersome paperwork that could be stolen, get burned. Somebody can steal that from you. So because of all these difficulties, administrative inefficiencies, bonds being made electronic. Now you don't see coupons except few. That's also for various purposes, but generally these are electronic arrangements now. So the bonds with coupons attached, okay, that represent periodic interest payments, generally semi-annual. Okay. Also, when it comes to such coupon attached one, you see it's a bearer bond. Whoever hold, who is eligible to get the coupon. Okay, so bearer, whoever holds, right? So you can see here, right, using the same strategy used for other financial instruments in the market like simple loan, fixed loan payment. We use the same fixed loan payment formula, and you see the jargon is slightly different here. P is price of the coupon bond. C is yearly coupon payment. Okay. F is the face value, as I was mentioning at the last maturity period, maturity point, you get the face value. P is the price that you are investing. This price may be different to face value, depends on coupon and the I, market interest rate. I is market interest rate, right? So you can see, then you see number of years in that you see all the time. So all coupon receipts up to the maturity, and then you see the final payment of face value. All can be discounted back to see what's the price of this bond. That depends on what's the I is. If the I is greater than coupon C, C is coupon, I is market interest rates. When the I is greater than coupon, market interest rate is greater than coupon, you already know you are paying a price that is lower than the face value. That means you are buying this bond at a discounted price. The I is lower than the coupon. You are buying the bond at a price which is greater than the face value. That means price is a premium, and you buy a premium bond. If the C and I are equals, you are buying a bond at a face value, and a price is known in this instance as par value bond. So these are the ones, that concepts that you learned and discussed a little while ago. Very important aspect you should not miss when it comes to bond pricing, bond directions being discussed. I don't want to see that you are using X, Y, Z equations to calculate bond prices. No, you should know the direction, whether it's a bond discount price, whether it's a premium price or a par price, by looking at the coupon and the market interest rate. You should be able to do that, because today, if you are going to work, you don't need to worry about all these calculations and all. They have bill system, you have computers, laptops, and you have calculators, bond calculators for doing all this work. But concepts is important. You should know where the direction is. So even without compiling, computing, you can get where should be the price. You should principally know this is where the price is. Then you can work out, because you will not make mistakes if you learn like that. Otherwise, you have to memorize everything. Okay, the understanding of the principles is very important when it comes to this type of a subject, this type of a element that we are discussing. Okay, so we will get into this price and coupon and interest rate, as we already discussed in YTM, yield to maturity analysis, with very clear explanation in the next slide. Before I move to that next slide, any questions? Right. So you see here the table 1, right? You can see this bond where yield to maturity is compounded. Yield to maturity is compiled, not compounded, compiled. Okay. You see yield to maturity on a 10% coupon rate. That means C coupon is 10%. If it is semi-annually paying, you see it is 5% in 6 months. If it is quarterly paying, 10% coupon, quarterly paying, that means 2.5% in 3 months' time. Okay, so that basic concepts that you know in a bond. But this bond mature in 10 years. So lifetime of this bond is 10 years. If it is a semi-annual, you will have 20 points of coupon payments, right? So face value, investment value is different. Face value of this bond is 1,000. At maturity, you will get 1,000. Okay. Or you see at the time of investments, irrespective of the price, the contract will say the face value as 1,000. When you see a price of this bond is 1,200, which is price is higher now, 1,200 than face value 1,000. You already know under what circumstances price would be higher than the face value. It is nothing but the circumstance where market interest rate is lower than the coupon. Okay, so when the market interest rate is lower than the coupon, you have to pay a price. That price is more than the face value of the bond. So that is what you are seeing here. When you are seeing 1,200, you see the yield to maturity, which is 7.13. What it inside the equation, what is this is, although market interest rates are around 7%, this bond is paying you 10% every year. That means additional 3% this bond is paying for you. Just calculate 3% of $1,000. $1,000, 3% is about $30 per year, right? So you factor that to 10 years, it's about $300, isn't it? So you are getting 3% additional interest return from coupon payments, but this coupon payment is higher than prevailing market interest rate. So to compensate that higher coupon receipts for your hand, what you do here is you pay at the time of purchase value to the face value now, more than the face value in terms of your investment value. So you pay 1,200 and you get a return for 1,000 face value maturing bond, which is 7.13. When the price is greater than the face value, market interest rate is lower than the coupon rate. Same thing applies to 1,100 also. There are also prices greater than the face value, but the price is not that greater than 1,200. So still market interest rate is lower than the coupon value, but not lower as the price at 1,200. That's why 7.13 now become 8.48. It is like 1.5% for 1,000. 1.5% for 1,000 is how much? 15 per 1,000. For 10 years, it's about 150. But when you discount it to present value, you will get 1,100. You have to pay additional at the buying time, right, to compensate for higher coupon receipts during the lifetime of this bond. But then we also see face value is equal to the price of bond, par value. All what you learn, higher prices than face value is premium bonds. 1,200, 1,100, which are premium prices, where market interest rate is lower than the coupon rates. You can put a bracket there and you can write it for your easy understanding. But when the price is equal to face value, we already know coupon is equal to market interest rate. So see, 1,000 is equal to 10% coupon and market interest rate is equal to 10% yield to maturity. Then you see now the prices are reducing. It's lower than the face value. For 1,000, now the price is 900. We already know principally you are paying a discount price. Okay, earlier it is premium price, 1,000 is par price. Now you are getting below 1,000, that means less than the face value. That means the market interest rates are greater than the coupon rate. Coupon rate is 10. See the market interest rate yield to maturity here, 11.75. When it comes to 800, more stronger, 13.81. So what you are basically seeing is the concepts that we have learned, coupon bonds, now elicit out for your information. And that information is when the coupon bond is priced at its face value. That means 1,000 is the price, face value is also 1,000. The yield to maturity is same as the coupon rate. I was repeating, market interest rate is same as the coupon rate. So you buy the bond at the face value itself. Par price, P-A-R, par price. These are par price bonds. Right? So then the circumstances arise, the price of a coupon bond and the yield to maturity are negatively related. What is the negative relationship? When one variable increase, other variable decrease. Okay, so negative relationship is the directions are different, not the same direction. Okay, price of a coupon bond and the yield to maturity. If the prices are increased, yield to maturity decrease, the negative relationship. See the price, 800, 900, 1,000, 1,100, 1,200. What happens to the yield to maturity? 13.8, 11.7, 10, 8.4, 7.1. Prices are increasing, yield to maturity are decreasing. Negative relationship. From 1,200 to 800, if you look at it from the top to bottom, the price side, prices are decreasing. Yield to maturity are increasing, 7.13 to 13.81. Negative relationship. Always the price of a bond and its yield to maturity are negatively related. So if somebody simply come and tell you the yields are increasing, it should be reflective in your eyes, the prices are decreasing. If somebody say bond prices are increasing, what it say is yield to maturity or the current interest rates are decreasing. So from a perspective of issuer or the borrower, increasing prices are good. Then his interest payment would be lower. Higher the price, lower the return or the lower the interest rate. These are concepts. This is what you all have to get into your head. Numbers, all kind of things you can do, but you have to build the concepts. So foundations, this is what very, very important. If you know this, whatever, wherever you discuss, you know, I mean, yes, interest rates are increasing, then the prices should decrease. Prices are increasing, interest rate should decrease. That will not go away from you. That's what lacking most of the time in concepts. Whoever discuss in different forums, they talk about bonds, talk about economics, but they lack the foundation basics. So if the basics are right, you know, anything happens to these prices, that should be reflective in interest rates and how, where, what direction, all is visible for you, but not necessarily X is 12%, Y is 8%. No, that is outcome. You will definitely know if when the price is 1,000, if the interest rate is 10%, when the price goes to 1,200, interest rate should definitely has to go lower than 10%. You can't say interest rate is 11%. That's a fundamental error, right? So this, I mean, learning is to kind of, you know, build that foundation, build that understanding. Okay. So then another very important point. First point is when the coupon bond is priced at its face value, yield to maturity is equal to the coupon rate. Second point is price of a coupon bond and yield to maturity are negatively related. The third point is yield to maturity is greater than the coupon rate, okay, when the price is below its face value. Conceptually, you understanding now, when the interest rate or yield to maturity, YTM, is greater than coupon C, the price should be lower than the face value. Okay. So the other way around, the same thing you can say is when the yield to maturity is lower than the coupon rate. This is greater than. You can write it as lower than the coupon rate. Then the bond price is higher than the face value. That's what you are seeing here, about 1,000. You just twist this, greater than, below, you twist those stuff. The direction should be same. You should see the negative relationship. The price increases, interest rate decreases. If interest rate increases, price decreases. Negative relationship. The behavior is opposite to each other. Okay, so that's very important. It is very important in terms of conceptually understanding the interest rates. right? So we will see coupon bonds is the general a bond in the market. But in addition to that, there are various forms of bonds. A slight introduction into those now. This is also, right, very, very important, because you will not come to know this type of concepts unless you study. And here, very interestingly, you see a concept called consol or perpetuity. There is no precise time defined for maturity. They don't say maturity is in 50 years. It's a long-term instrument, right? So one with no maturity date that does not repay principal but pays fixed coupon payments forever. This is a kind of instrument mostly used in advanced economies where investors have invested in charitable kind of assets. So they wanted to build a elder's home. Somebody wants to invest in that. He has invested, and he is now not going to live for 100 years. But the return he wants to go to one of the good work that he does, extending scholarship or to one of his family relatives. So he basically invests, and return is fixed for lifetime or beyond. No maturity defined. It's a perpetuity. So every month or every year, they get a fixed coupon payment. But that fixed coupon payment, as the time goes on, reduces in value. 1,000 rupees today is valuable, more valuable than 1,000 rupees tomorrow or 10 years from now. So they will get the payments, fixed coupon, unless there's a change in the process, they will receive it. So this is the consol, this is the perpetuity. So there is no maturity defined, okay? There's no assurance to repay the principal, but they could pay once the asset being sold. They will distribute across investors, but they pay fixed coupon all across the lifetime or beyond of that project. There is no fixed time duration. But interestingly, in such financial assets, the price is defined as P equals C over IC. I is interest rate, okay, O yield to maturity, and in this case, C, IC, yield to maturity of the consol. C is yearly coupon or interest payment, okay. So price of a consol, P, if you wanted to know the price of a consol, you basically look at it in terms of the coupon that the consol is paying you, and then you look at what is the prevailing interest rate, yield to maturity of a consol. If the market interest rates are again greater than the coupon, you know what the outcome is. Okay, so you can rewrite this equation to reflect in terms of IC. IC is yield to maturity of a consol is nothing but C over P, coupon over price. This is the same equation, current yield. If you wanted to compute the current yield, you see the coupon, you see the price of the bond, C coupon over price of the bond, you will see current yield, that is the interest rate. So same formula can be applied in terms of for coupon bonds in finding out the current yield. Okay, it's a easy way to find out the approximation to the yield to maturity. Yield to maturity is much more clearer, but current yield, it changes because you see the price changes. Today's price change tomorrow based on the prevailing market interest rates. But that's an approximation to where the yield to maturity is. Okay, so it's a way in which markets look at today's price of a bond which has been issued 5 years ago, but mature in another 5 years time. So where the price is, they look at the current yield. So current yield is nothing but C over P. C is coupon, P is price. So that's the way in which you have to get the concepts right. The concepts right means you will be able to see where the prices of these financial assets. Okay, so I have touched upon discount, not discount, the coupon bonds, and an extension to coupon bond in terms of what you see in financial markets, a console or a perpetuity. Prior to that, we have looked at fixed term loans, simple loans, and the concepts of yield to maturity. These are very important in terms of understanding the foundation of interest rates analysis. And from the perspective of understanding this, if you get the picture right, it's very easy to understand when it comes to explanation, where the markets are behaving, why the interest rates are moving, all kind of discussions that you will see in the next lecture and the lecture after. It's very straightforward and easy, but conceptually you have to get this. If you get this, it's very straightforward, and also very important in terms of understanding the subject behind this discussion. Any questions? And there was a question I saw, somebody wants to see timeline being used for application. Here you are. You see coupon versus price. That's a one application. But when it comes to coupon payments, in some aspects, you see a coupon is half of the coupon rate. Okay, so if you see 10-year, 5-year bond, you have 10 coupons. So if it is a 5% coupon, you see 2.5% coupon is one period coupon received. So you basically look at it, but if you wanted to apply that timeline to the current yield, you should not take only that period's coupon. You should take the coupon as a per annum statement. So you take the 5% over price. If it is 100, you can see, you can figure it out what's the current interest rate is, current yield is of the bond. Okay, C over P. But you see the coupon rates and the timeline. Timelines could be based on the coupon period, 6 monthly or let's say 3 monthly, then 10% divided by 4 for 3 months. That means for a one period, it is 2.5%. If it is 6 monthly, 10% divided by 2, you see it's a 5%. But when you're applying that for current yield compilation, you see you basically take 10% over what is the price of a bond. Price at that particular moment is less than 100, greater than 100 or 100. You will basically end up as the current yield, either a interest rate that is greater than coupon, less than coupon, or equal to the coupon. So it's a concept that you have now learned, and it's a matter of applying as you move on with these concepts that we are now taking to apply in our discussions in a next lecture and the following lecture, and most likely throughout your application in practical work. When you see a financial asset, you should be able to look at it. And then you look at a discount bond. Here, one important element of a discount bond is, okay, the discount bonds normally do not carry a coupon. That's why I said at the very beginning itself, instead of a discount bond, you can call this as a bill, a treasury bill. Treasury bill is not paying a coupon. But the return of this bond or a treasury bill is the discount rate or the price difference from the face value that you are getting at the maturity. Any bond, any bill at maturity pays you the face value. In Sri Lanka, the face value is 100. In US, face value is 1000. And in another country, it could be different, but generally it is 100. Okay? So when you see a discount bond, if that bond is not paying you a coupon, anybody who wants to get a return, he would invest in the discount bond at a price, that price is lower than the face value. Okay? At a price which is lower than the face value, simply because you are getting the face value at maturity. Right? So this is not going to pay you a coupon. But how you get a return is your investment value versus face value at maturity. So your investment value is lower than the face value. So in the interim, the duration from investments to maturity, price accumulate if you hold till maturity. That's the usual process. But if you wanted to trade it in between, your price would be based on the market interest rates prevailing at that moment. If the interest rate structure has increased, your price would decrease. So even you would not be able to get a return for the period that you held if you try to sell that before the maturity, because you are exposed to market risk of interest rates volatility. Because interest rates are moving up and down in the market, right? So to avoid that volatility, you can invest and hold that asset till maturity. So you are not exposed. But if you are a sophisticated investor, you don't do that. You try to benefit yourself from interest rates movement. So as long as you see interest rates are declining, you know your price would have gone up. So you try to sell it and get a capital gain in such circumstances. That's all possible. We will get to those in greater details. But discount bond here, for a 1-year discount bond, I is the interest rate or the current yield, right? So you see here, the equation is F minus P over P. P is price, F is face value. Face value, as I said, often 100, or in the case of US, it's 1000. Okay, P is the current price of the discount bond. Okay, so it is nothing but the yield to maturity equals the increase in price over the year divided by the initial price. So if you see this bond, right, is held for 1 year, but its maturity is 2 years. At this point, you have purchased it at 90. And now after 1 year, this price has increased to 95. That period's change in price is the return, yield to maturity, increase in price of the year divided by the initial price. So initial it's 9, that period's change in price is during the period. Okay, so that's how you calculate it, because often these discounted bonds are not long-term assets, either lower than 1 year, or that's why I said bills, it is 3 months, 6 months, 1 year, the most. But there are some countries, they have 18 months treasury bills also, right? As with the coupon bond, yield to maturity is negatively related in current bond price also. The prices are increasing, yield to maturity is decreasing. If the prices are decreasing, yield to maturity is increasing. Negative relationship. Price and the yield, or for that matter, interest rates, are negatively related. Higher the price, lower the interest rates. Lower the price, higher the interest rates. So don't forget, this is very important. I was repeating this even in our last few discussions. So there are a rate of return, a concepts of distinction between interest rates and return and things like that. This is very important, and I don't want to touch this until you have a very clear understanding of the concepts of whatever we have discussed up to now. So I prefer to give you a time to read this again. Apart from what we discussed, try to get it to your head and very clearly figure it out. When the prices are greater, lower, equal to face value, what would be the yield to maturity? These are concepts, very important. With the table, I was trying to explain and try to get you into the basics of understanding those concepts, right? So by having that understanding, it's very easy in terms of recognizing which directions the price behave, which direction the interest rates behave, what should be the price, whether it's a face value, whether it's lower than face value, greater than the face value. If the face value and the price is such, what's the coupon, what's the interest rate, yield to maturity. The yield to maturity is greater than the coupon rate, lower than the coupon rate, equal to the coupon rate, all that. That is very important because you have to recognize it, and then we'll come to this point, rate of return, and then trying to see what's the component current return plus there's another component here that is the capital gain I was telling. So we'll try to get in with real conceptual insights in our next discussion with the next new handout also. So for the time being, I'll stop at this point because this little can be finished before we move into the next lecture next week. So any questions that you have before we wind up? Please read, because this area is very important, and basic understanding of the foundation would keep you in good stead to get a kind of feel on the direction. And compilation, computation, I don't think we are worried about those stuff. We wanted to see where you are in terms of understanding what's the direction and things like that, as I was mentioning. Right, if you don't have any questions, we'll stop at this point, and we'll revert to our discussion next week. Please read and take a look at the general reading and other materials that we are recommending under normal circumstances for you to follow the subject much more clearer. And then you see, as you get to the business end of these discussions, most of these will be application and much more easier with the understanding that you have of these concepts. So we will learn those and try to kind of get hold of the financial markets and economics of monetary policy. It's very, very important in today's context. Okay, then stay safe, and we'll stop at this point. Thank you.